What is happening with Apple stock, which is down nearly 12% year to date, while we have other companies in the Mag 7 up, with Google up 7%, Amazon up 18%, and others up some very strong performances in 2024 so far. So why is Apple lagging behind the others? Today we're going to take a look at one of the main reasons now with this antitrust lawsuit that they are facing. We're not just going to look at this, we're also going to point back to another time in history, specifically 1998, when Microsoft also faced these antitrust charges and how that worked out for this company. We're also going to take a look at some other pieces of information today. We're also going to take a look at Apple's product line, seeing what are they bringing out in 2024 to really help their income stream increase, as it has started to lag now over the more recent few quarters. And as usual, we will take a quick look at their revenue, both top line and their net income bottom line, as well as refreshing on the health of this company, their total cash versus their total debt, and look at not just their dividend safety, but at their financial metrics, including their free cash flow growth over the more recent year. As always, we will put them through the valuation model, getting to our updated intrinsic value, seeing what Wall Street are forecasting, and we're also going to take a quick look at 3 different targets, low, medium, and high, for this giant company. So let's have a very quick look now at their historical performance. Yes, they are down around 12% year to date. However, over the last year, they are still up 8%. And over the last 10 years, if this is one you have been holding, you would be up 788%, excluding those dividends reinvested. We can see they are trading in the mid to lower end of the 52-week range. They have a forward PE of 26.26, a forward yield of 0.56%, and a market cap of 2.66 trillion. So what is the issue that Apple now face? They are down 12%. Well, we want to go back in history right now to 1998, where Microsoft faced similar antitrust charges, and see how they managed to perform after that. Firstly, for those that don't know, antitrust laws ensure that companies don't control the market despite consumer choices, as well as inflating prices, so effectively creating a monopoly. Now, this is something that was brought against Microsoft, as we can see, in 1998. Now, they did appeal the decision, however, this was overturned. And for those that don't know the history of this company and how it essentially performed during that, so we're going to take a look. So we can see from this article that Microsoft stock hit a highest point since the judge ruled it broke antitrust law back in 2000. Now, this article was written in 2015, so we are talking about 15 years. That is a very long time for a company to try and break its all-time high. So we can see in 2000, between March the 31st and April the 3rd, Microsoft's stock price dropped 14%. And whilst they did say it never recovered, we can see in 2015, it did recover to break their all-time high of over 15 years after they essentially beat the earnings report that Wall Street had expected. So we are talking about data which is really historical data in the past, but it is something just to let you know, to be aware of, as it is an interesting fact that this is something that did affect Microsoft's stock price very strongly nearly essentially 24 years ago. Now, we can see the same or a similar thing is happening with Apple. As we can see, they do believe they are essentially having a monopoly. And when we take a look at some of the comments and some of the points that are being regarded with this, we can see that the complaint is essentially that Apple has maintained monopoly power in the smartphone market, not just by staying ahead of the competition on merits, but they believe they are violating the federal antitrust law. And we can see the share price, since this news has come out, has taken a bit of a plummeting, down really 3% just over the last 5 days. And as we can see, over the last few months now, down 12%. So let's find out whether or not this is a company we should be looking to add to our portfolio, or whether or not, if it is one you do hold, something you should consider selling. Now, I have pointed this out on other episodes. In terms of their total revenues, it is nice to note it has increased over the last 5 years, 260 billion to 383, which is significantly higher than the 3 to 7% that we do look for steady modular companies. Now, year on year, we can also see it has increased although we do know in the more recent year their top line has reduced, and we'll talk about why we believe that in just a few minutes. Now, in terms of their bottom line, we can note it has nearly doubled from 55 billion to 97 billion, but it does follow a very similar line to the top line, where it increases up to 2022 September before decreasing in the more recent year. So yes, top line, bottom line have increased, although the more recent year it has dropped. Now, health of the company, realistically no real issues. We can see their cash and short-term investments, whilst it has dropped by around 30% from 100 billion, it does sit now around at a 73.1 billion mark, which is still very strong, very healthy. And when we compare it numerically and directionally to their total debt, we can see it hasn't really moved. 108 billion, pretty much just a few million less. So whilst they do hold a very strong cash position, they do hold a very high debt position, but there are no real worries with this, and we will take a look at the net debt to EBITDA just to back this up again shortly. Now, insider trading, nothing really to note here since the last episode. We can see there has just been that one sale by Arthur Levinson, the director, at the end of February for around $18 million. But as always, it isn't necessarily a bearish signal, but we will just make that apparent to investors or even potential investors. Institutional ownership is still 58.51%, and we do see that whilst the institutional outflows have been very significant over the last 12 months, there's been nearly twice as much buying in the same period by the institutions, and we know over the more recent quarter as well, 77 billion worth of buys as opposed to 16 billion worth of sales. So institutions still buying in the more recent period, as well as on average over the last 12 months. Now, we just wanted to bring to your attention in terms of new products that Apple are bringing out in 2024. Well, we can see when we do take a look at 2023 what Apple had brought out. You do note a very common theme throughout these new products. We're talking about historical products from Apple that they are essentially just renovating. We're talking about an M2 Mac Mini with M2 Pro, different processors, different screen sizes. They are still the same products that Apple have had for quite some time. There is no new products. Now, when we do look at 2024, you wouldn't be surprised as this is very well advertised. The Vision Pro was released in February, and we can see in March the M3 Mac AirBook Pro. So we really need to understand whether or not Apple are having any new products that are coming out or anything that is in the pipeline to really help grow their top line, which they are struggling with. As we did see over the last year, their top line has reduced, and a certain element to that is China, with the sales having slowed down. Now, this is one of the things that does annoy me a little bit with Apple. We want to see new products. They're bringing out the same products with maybe better processors, but now they're talking about how iOS 18 could offer a more personalized and customizable home screen on iPhones. It isn't necessarily what investors want to see. We want to see new products from Apple that really will help trigger Apple's growth into the next 5 to 10 years. And you would expect at some point they will bring something out for AI, which will hopefully increase their sales given their fantastic ecosystem that they have with their users and consumers. Now, in terms of the metrics, they do have a very safe dividend safety score at 99. Not surprising there given how large their cash balance is. Market cap 2.67 trillion, so they are a mega cap company. Now, we've talked about their key metrics before. They have had some very strong numbers, plus 14%, so higher than the average of the S&P, which was around negative 12%, but they did have a near S&P return, negative 50% versus the S&P's negative 55%. We are waiting on a dividend increase over the next few weeks. We can see in May last year, they increased it at 4.3%. So in line with inflation, not really what you want to see, especially when the yield is at that 0.53% level. Although over the last 5 years and the last 10 years, a little better in the mid to high single digits. In terms of number of years, well, they have increased those dividends for the last 11 years. Now, dividend yield theory, for those that are new to the channel, it states a company is undervalued when the current yield sits above the 5-year average. So based on this, we do see a sign of overvaluation / slight reasonable valuation. But again, we don't look at any of these models in isolation. Forward PE, we can see it is roughly in line with the 5-year average. And when we compare it to the information technology, it isn't too far off it at 25.9. Now, the free cash flow payout, no worries in terms of them being able to pay the dividend, not just from that dividend safety, but we can see it is significantly low at 15%, expected to be there or thereabouts in 2024. So as an investor, they do sit on a lot of cash. It would be nice to see a much higher dividend increase than 4.3% that we saw last May. Now, free cash flow is very important. What you want to see from a company, even though we do see that their top line has been slowing down, that they are continuing to increase their free cash flow. Now, they've increased it by 3 times over the last 10 years to 633. 2024, nice to note, it is expected to increase. And bear this in mind, they are expecting an increase, and this will factor in when we take a look at our valuation model at the end of the episode. Sales growth, again, very inconsistent. 3 of the last 10 years where they had negative growth, notably the more recent year. But they do have some years with strong double-digit growth. This is why it is important to understand what they do have in their pipeline. And hopefully it's just not another better operating system or the Mac, which has been just refurbished with a better processor. Total sales we see more than doubled over the last 10 years to $383 billion, and it's always nice to note when they return excess cash to investor pockets, increasing your pie or your stake in the pie, going from $24.5 billion in 2014 to $15.7 in the more recent year. ROIC, nice to note, it has been not just increasing over the last 10 years, but it's 61%, very, very strong, especially for me as an investor. I want to see a minimum of 10%, and they have done that, but much, much better consistently as well. Margins, no issues here in the low 30s or in fact 30% over the last 3 years, so very strong, above that 12% minimum we want to set, and free cash flow well above the 5% every single year. So this is still a very, very strong company, but if you do believe their growth is slowing, then the valuation or the price you do pay does become very important, which we're about to touch upon. Net debt to EBITDA, so the earnings before the interest, tax, depreciation, amortization, as we can see, 0.44 reducing to 0.24, absolutely phenomenal when we want to see below 3. So we can see not just a strong balance sheet, but also for those that are worried, the dividend does look to be very safe. Now, before we jump into the valuation, just to let you know, we have released our latest free weekly article. If you want to gain access to this as well as all the others, click on the pinned comment below to sign up, all completely free, and you gain instant access. So let's jump into the valuation model. Now, the discounted cash flow model makes up 1/2 of today's intrinsic value. Typically on the channel, we do run through every single model. However, for Apple, the only ones that we do deem to be relevant are the multiples valuation model, which, as you can see, we have 3 that are in a similar sector and size. We have their average P multiplied by the EPS of Apple to give an intrinsic value of $210. So we have our first sign of undervaluation. Bear in mind, though, we're not looking at any of these models in isolation. We then move on to the DCF model, where we have the free cash flow year on year. Now, the average growth rate at 9.9%, we've pretty much gone for a forward looking at 10%, so very similar to the last 10 years. With a discount rate of 8%, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we can see we have our intrinsic value at $206, another signal of undervaluation. Now, for those that believe that 10% is too low for Apple, we have gone for a medium rate as well. So at 12%, if you do believe that to be correct, then you can see the intrinsic value comes to $237, which signals 39% upside. Now, for those who believe that is still quite pessimistic and would go for 14%, we can see this would bring around 60% upside over the next year with a value of $273. As always, if you do grab a copy of this model in the pinned comments below, you can run your own numbers throughout the whole model, whether you want to go through Apple again or any others in your portfolio or watch list. So we're going to take through to the final calculation, the 10%, which we deem to be the lower end for the growth rate, and we get the intrinsic value, which is just the average of these 2 models here. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, margin of safety, as always, 10%. Remember, if it meets 3 criteria: wide moat, strong financial metrics, and good forward-looking data. Margin of safety at 10%, it is a buy up to 187, 15% at 177. So we're already seeing quite a nice margin of safety for which is a very strong company, or a company that has historically been a very, very strong. Margin of safety at 20% at 166. Now, we aren't quite there yet, so right now we can see a 15% MOS level based on those estimates and judgments that we ran through in today's episode. Now, in terms of Wall Street and their forecast over the next 12 months, we can see upside of 20% with a price target of $204. So they do see this as very undervalued right now. Personally, for me, this is one I do hold indirectly via ETFs. However, if we do start to see some nice value at around a 20% margin of safety at $165, $166, that is where I will personally start to dollar cost average, as I do see a lot of value with this company. Whilst their pipeline at the moment doesn't look to be too strong. There aren't any products like the Vision Pro that I believe to be as strong as the iPod, the Essential Mac, or even the iPhone. I do believe that Apple, over the course of the next few years, will bring out a product that will be very strong, and then a lot of people in their own ecosystem that they have will start to buy. As always though, do let me know your thoughts, not just on the valuation, but also on the antitrust laws, whether or not you do believe that this will send the share price going down further, and there will be a period like we saw for Microsoft of nearly 15 years where the share price essentially never reached its all-time highs of 2000. As always, if you enjoyed the video, smash the like button, do let me know your thoughts in the comments below, and as always, we'll see you on the next one.